Eurozone inflation just threw a curveball, and the European Central Bank is now cornered. After months of cautious optimism, new data shows price growth accelerating again in several core economies. Investors had been betting on a soft landing, a smooth disinflation, and a dovish ECB. But the numbers suggest something different, a tightening trap. And the consequences may extend far beyond Europe. Let's start with what just happened. According to Eurostat, consumer prices in the Eurozone rose 1.9% year-over-year in May, dipping just below the ECB's 2% target for the first time since September 2023. That may sound like progress, but under the surface, things are heating up again. Core inflation, which strips out volatile food and energy prices, is proving far more stubborn. The latest reading shows core inflation sitting at 2.4%, still well above target. In countries like Germany and the Netherlands, price pressures on services, housing, and insurance are climbing again, and that's putting the ECB in a bind. Why? Because the central bank has already cut rates 8 times since June 2024. The deposit facility rate now sits at 2%, down from a peak of 4.0 just a year ago. Markets had priced in even more cuts by the end of 2025. But this resurgence in underlying inflation is forcing a rethink. ECB President Christine Lagarde recently said the 2% inflation goal is within reach, but hawkish voices are growing louder. Bundesbank President Joachim Nagel warned against signaling further cuts, saying we should neither signal a pause nor a continuation. Vice President Luis de Guindos echoed that sentiment, urging caution and data dependence. Here's why this matters globally. The ECB's easing cycle was supposed to pave the way for synchronized monetary relief. Investors expected the Federal Reserve and Bank of England to follow suit, unlocking a wave of liquidity and rate normalization. But if Europe stalls now, or worse, reverses course, the ripple effects hit everything from emerging market debt to U.S. yield spreads. And there's a deeper issue, credibility. The ECB spent nearly a decade fighting deflation. It took extraordinary measures, negative rates, bond purchases, and targeted lending just to get inflation off the floor. Now, having briefly touched its target, it risks easing too far too fast and letting price instability return. There's no easy way out. One of the key drivers of this latest inflation uptick is energy. Oil prices have rebounded on geopolitical tensions in the Middle East, and the recent conflict spillover between Israel and Iran has added further volatility. French central banker François Villeroy de Galhau warned this week that agile pragmatism is needed to navigate the risk ahead. But inflation isn't just about oil. Across the Eurozone, services inflation remains sticky. Wages are rising in countries like Spain and Austria, and businesses are passing those costs on to consumers. The labor market remains tight, especially in healthcare, construction, and logistics, creating a feedback loop that slows disinflation even as demand cools. And here's the tension point. The ECB's own forecasts show inflation averaging 2% in 2025, dipping to 1.6% in 2026, and returning to 2% in 2027. That long glide path means monetary policy needs to remain restrictive for longer than markets had hoped. With growth near stall speed and industrial production flatlining, that's a dangerous balancing act. This is where things could break. If the ECB hikes prematurely or even signals a hawkish pivot, it could trigger a credit crunch in weaker economies like Italy and Greece. Yields on sovereign bonds would spike, borrowing costs would rise, and banking pressure would return, especially in countries still carrying high debt loads from the pandemic response. But if it stays too dovish, it risks triggering inflation expectations to re-anchor above 2%, a scenario that could force emergency tightening down the line. And that's the open loop. What if neither option works? This isn't just about interest rates. It's about control. The ECB, like the Fed, like the Bank of Japan, is trying to manage inflation, growth, and financial stability all at once. But the tools they have are limited. And right now, every lever pull creates a new risk. At this point, even central bankers admit the path forward is murky. Lagarde, de Guindos, and Nagel have all used the phrase uncertainty in their latest speeches. That's not just caution, it's a warning. And here's your stat hook. According to the ECB's own internal minutes, 11 out of 26 voting members now believe the current rate path is too accommodative, given core inflation trends. That's a growing block. And if inflation doesn't cool sharply by July, we could see policy guidance shift sharply. So what should you watch? Number 1, wage growth trends in Germany and France. If wages keep rising, inflation will persist. Number 2, energy futures. If oil stabilizes above $85 per barrel, the inflation fight becomes harder. Number 3, ECB communications. If officials start using language like vigilance, overshooting, or recalibration, the market is about to get jolted. And here's the final emotional spike. We're watching a central bank that's been through a decade of extremes, from negative rates to COVID stimulus to near double-digit inflation. Now, at the edge of normalization, it's realizing the scars run deep. One wrong step, one policy misfire, and the Eurozone could slide back into volatility. The bond market knows it, the Euro knows it, and soon everyone else will too. Stay alert, track inflation, and listen closely because the ECB's next move could change the course of global finance. But there's a bigger shift underway, one that stretches beyond Europe's borders. Currency volatility is back. As the ECB hesitates, the euro has begun to wobble. In the first half of June, the euro slipped below 1.07 against the dollar, the lowest since April. That drop wasn't just about ECB policy divergence. It reflects deeper uncertainty about the bloc's ability to steer out of its stagflation shadow. And that's exactly what's forming now, a slow-motion stagflation risk. Growth across the Eurozone remains fragile. Germany narrowly avoided recession this quarter, with just 0.1% GDP growth. Italy's output shrank in Q1. Industrial reduction across the region is stalling, and yet inflation remains persistent, especially in consumer services. This mismatch creates a feedback loop that central banks struggle to navigate. Raise rates and you crush already stalled growth. Cut rates too fast and prices accelerate again. Meanwhile, fiscal politics in the EU are adding pressure. France is heading into surprise legislative elections, while Germany faces internal battles over energy subsidies and labor contracts. These uncertainties limit the ECB's policy maneuvering because fragmented political support makes coordinated stimulus far more difficult to execute. And that matters for bond markets. If confidence in the ECB's trajectory weakens, the market could start testing peripheral debt. Italian 10-year yields have already widened 60 basis points versus German bonds since April. Any sign that the ECB is losing grip on inflation could send that spread spiking, a replay of the 2011 debt crisis in slow motion. That's what's at stake now. This isn't just about a few decimal points on inflation reports. It's about the credibility of an entire monetary regime built over decades. And when credibility cracks, it rarely recovers cleanly. The next few weeks will determine whether the ECB regains control or if Europe slips back into financial turbulence that could ripple worldwide. One last point, watch the bond buying programs. If the ECB is forced to restart quantitative easing or deploy its transmission protection instrument, that will be the clearest signal yet that control is slipping. Subscribe to Wealth Signal if you want the real story behind the numbers before they hit the headlines.